Imagine a group of everyday people on the internet, armed with nothing but their phones and a shared sense of injustice, deciding to take on the most powerful players on Wall Street. They didn't just fight them. They sparked a financial earthquake that exposed the hidden rules of the game, made billionaires cry foul mirror, and for a brief, glorious moment, turned the stock market into the world's largest casino where the little guys held the dice. This is the true story of the GameStop saga. In early 2021, the world's attention was ripped from the pandemic and glued to a stock ticker, GME. Unveiling video game retailer, GameStop, became the unlikely battleground for a war that redefined finance, culture, and what we think is possible in the digital age. It was a perfect storm of memes, money, and market manipulation. To understand how it happened, we need to start with the simple Wall Street tactic that set the entire powder keg ablaze. The core of this story is a bet called short selling. Here is how it works. Big hedge funds borrow shares of a company they think is going to fail, like a brick-and-mortar video game store in a digital world. They sell those borrowed shares immediately, hoping the price will crash. Then, they buy the shares back at that lower price, return them, and pocket the difference. It's a profit from failure. By 2020, hedge funds, most notably Melvin Capital, had bet that over 140% of GameStop's available shares would fall. They were too confident. They saw a dying company. But on a subreddit called WallStreetBets, a community of retail traders saw something else, a trap. WallStreetBets wasn't your typical investing forum. It was a chaotic blend of financial jargon, absurdist memes, and life savings risked on YOLO bets. Here, a user later revealed to be Keith Gill, a regular guy from Massachusetts, posted his detailed analysis. His thesis was that GameStop was undervalued, and the short sellers were dangerously overexposed. He backed it up with his own money. His posts went viral. The community rallied around a simple, powerful idea. If we all buy shares and, most importantly, hold, the short sellers can't cover their bets without driving the price up further. It was a short squeeze, weaponized by the masses. The mantra became to the moon and diamond hands. This wasn't just about money, it was a revolt. In late January 2021, the plan exploded. GME, trading at $20 just weeks before, began a vertical climb. $40, $100, $200. Hedge funds were losing billions per day. Melvin Capital needed a multi-billion-dollar bailout. The revolt was working. Then, on January 28th, at the peak of the frenzy, the unthinkable happened. Brokerages like Robinhood, the very app that enabled this army, removed the buy button. You could only sell. The price plummeted. The free market, it seemed, was only free when the right people were winning. In a now iconic TV moment, investor Chamath Palihapitiya called it out live, asking, "They have the right to do with their capital what they want. Why can't they?" The question hung in the air. Who does the system truly serve? So, who won? The hedge funds bled, but most survived. Many retail traders sold for life-changing profits. Many others held on at the peak and lost significant money. The true legacy of the GameStop saga isn't in portfolios, it's in the precedent it's set. It proved that collective action, fueled by social media, can challenge institutional power. It forced a congressional hearing on market fairness, and it left us with two conflicting truths. The market is more accessible than ever, but the establishment still controls the levers when truly threatened. GameStop became a symbol. No longer of a dying mall store, but of a persistent, chaotic, and unpredictable new force in finance. Thanks for watching, and if you enjoyed this story, be sure to subscribe for more.